Good morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this new session of the financial statement series at the Peterson Institute for International Economics. And today we come back to something that was covered in previous, in at least one previous episode of financial statements, which is what happened in US banking supervision, particularly, of course, with Silicon Valley Bank, Signature Bank, and First Republic in March and April. This issue has kind of faded away from the news cycle, but it's not fading away from the scope of interest of this series, because there are so many questions about the extent of supervisory failure, whether there was a failure, whether it was idiosyncratic, whether it was systemically significant. And I couldn't think of better people to talk about that than Peter Conti-Brown and Rosa Lastra, picking up on the discussion we had with individuals with much more of a US regulatory profile than Tarullo and Sarah Bloom-Raskin a few weeks ago. Peter Conti-Brown studied at Harvard, at the City College of New York, at the Stanford Law School, and at Princeton, where he got his PhD in history in 2017. He has been a law clerk in two US Court of Appeals. He's also been in private practice of the law in the 2010s and has had visiting fellowships with several academic institutions. He's joined Wharton at the University of Pennsylvania in 2015, and since 2021 has been the class of 65 associate professor of financial regulation. And he's also a professor of business ethics and of legal studies. Peter also joined the Brookings Institution in 2019 as a non-resident fellow. Rosa Lastra, I should mention that Peter is probably one of the foremost, if not the foremost, historian of the Federal Reserve, both in its capacity as a monetary policy authority and as a banking supervisor, and has many forthcoming publications about this, which he may tell us about. Rosa Lastra studied at Queen Mary University in London, also at the London School of Economics and Political Science, at the University of Valladolid in Spain, and at Harvard Law School, where she got her LLM in 1991. She's worked at the IMF, she's worked at the School of International Public Affairs at Columbia University, New York in the early 90s, mid-90s. And since 1996, she's been at Queen Mary University of London, where she's a very influential voice in the debate about legal issues, particularly when it comes to financial regulation. I won't mention all of her academic affiliations. She was a visiting professor at the University of Stockholm in 2008, 2010. She's been a consultant for countless public policy authorities, the International Monetary Fund, the European Central Bank, the World Bank, the Asian Development Bank, the Federal Reserve Bank of New York, among many. So with that, Peter, over to you.
Thank you, Nicolas. Such a pleasure to be with you. And if you'll indulge me a somewhat personal note, it was a particularly special invitation, since I could share the digital days, so to speak, with my beloved friend and mentor, Rosa Lastra, who has been an absolutely path-breaking scholar in these topics, including with the publication of her really field-defining book on bank supervision, when I was still collecting those degrees that you mentioned in the introduction. Nicolas chose the title of this presentation, and I thought he chose it incredibly well. There is a debate presently underway about whether bank supervision is responsible for the, call it a banking crisis of 2023, a banking kerfuffle of 2023, whatever it was a systemic and in many ways seismic occasion for those of us who, not only those experts who follow the moves of the global banking system quarter by quarter, month by month, but of all of us who've been asking ourselves questions about what happened, what the role of government is in response, and then the topic of our discussion, what is the role of government to prevent such occasions in the first place? So here's my depiction of March 2023. with all of us kind of losing our minds along with Kermit the Frog. And here's where we are in June 2023, looking at the banking system and with some worry, shaking our heads, but feeling that the worst is behind us. And this is remarkable. In the same window, for example, in the last banking crisis that we had that was independent of the pandemic, a 3-month interval of corresponding in a corresponding period, call it March 2008 to June 2008, we would still very much be in full panic. The worst was yet to come. I'm a historian, not a forecaster, and my forecasts are worth what you paid for this registration. But I will forecast that we are not going to see anything like the fall of 2008 in the fall of 2023. And I think there's an important reason for why both we are where we are and are where we and were where we were in the spring and then today. Questions about risk management, for example, what happened on both the liability side for SVB, for First Republic, in terms of their funding base, in particular, their over-reliance on a lack of diversified clients, and on their reliance on the flighty uninsured depositors that constituted the majority of their funding, but also risk management on the asset side. In Silicon Valley Bank's case, it got duration risk all upside down, which is just a fancy way of saying it was holding assets that it thought were the plainest of plain vanilla when it acquired them in 2020, as it made the strategic move to grow very quickly, and then failed to stay ahead of a changing monetary environment. And now that, of course, leads to this other question: is the Fed responsible in its monetary policy side of the shop for exacerbating, maybe even causing, the banking crisis of 2023? Certainly SVB's decision in 2020 to go all in on very safe assets, while a little bit unusual in terms of its failure of diversification, it just grew very quickly along with the growth of the VC and tech sector, and needed somewhere to park its money. That doesn't look like the bad decision on the Silicon Valley Bank's part. And if interest rates had stayed at rock bottom levels, at the zero lower bound as they were in 2020, then I don't think we would be here having this conversation. They didn't stay there. The Federal Reserve did hike interest rates. It hiked interest rates in a more aggressively than it had done in 40 years. And so is that the responsibility then? Should we be thinking about government actions contributing there? Certainly, that's where the former managers of some of these failed banks point their fingers. They also point their fingers into a changed technological world, that this was a bank run like we used to see in the 1930s or in the 19th century, but instead of people lining up to make their cash withdrawals and thereby destabilizing the institutions on draw, they lined up with their smartphones, and their smartphones led by people who were fanning the flames of panic via Twitter. Now, I think that these first two are important for us to ponder. The one that we want to talk about, especially relative to these other three, is this last one. This question that happens anytime there's a bank failure, and that is, where were the bankers? Where were the bank supervisors? Banking is unusual, not quite unique, but unusual in regulated entities. Not only that there are many, many rules that apply to banks, but there are active efforts at sometimes contested, sometimes collaborated conversations about how risk should be taken. Banks are subject to exams, just like any student. Those exams yield answers. And the questions that we have now about those exams are, what happened? Why weren't they more stringent? Why didn't supervisors do more to prevent this? Now, there's some evidence that things are not so great in the land of US bank supervision, and hence the "in" part of the title of our presentation today: how ineffective was bank supervision? Michael Barr, day after the Federal Reserve's and other parts of the federal government's extraordinary interactions, promised a report. He issued that report, and that report was not very kind to the supervisors he in turn supervises. He thinks that the bank supervisors got this wrong. There's a growing bipartisan consensus that there should have been more done. Let me offer my contrarian view. Let me end here as I pass it on to Rosa to respond. What about the shoes that didn't drop? What about the fact that I think and feel confident that this is very much the consensus view that we are not headed toward another financial crisis? There are 10,000 depository institutions in the United States, more than 4,000 banks. The others are thrifts and credit unions. A recent study showed that a breathtaking 190 of those 4,000 banks probably made the same duration miscalculations that Silicon Valley Bank and First Republic had made, meaning that they've got assets that are on a market basis underwater relative to their notional value. 190 out of 4,000. That means that about 96% or 95% of all banks got ahead of one of the most breathtaking changes in the monetary and interest rate environment, and they did so quickly. Now, what accounts for this? Now, in some cases, I think that the bankers themselves deserve a lot of credit. Some bankers who saw, some very early, some very late, but most well in time, that this climate was changing, that they needed to get ahead of the changes in duration on the asset side of the balance sheet. Remember the old yarn that banking is a boring business that depends on a 3-6-3 model, that you pay 3% for deposits, you loan out at 6%, and you're playing golf by 3 p.m. In order to make that implied net interest income, bankers have to keep their assets above their liabilities and the interest paid and received. And that will always be a challenge anytime the Federal Reserve increases interest rates, as it had done most recently between 2016 and 18, well within recent memory for these bankers. Now, if the bankers deserve credit, I think the bank supervisors deserve credit too. As I look at the disclosed materials, which have been partial, I read them differently than I think most people, and that is because I read these as throwing red flags by the supervisors that were ignored by the bankers. I do not know this for a fact because these other reports for other banks are wrapped in secrecy, a legal doctrine called confidential supervisory information, which means it's criminal for the government to disclose those absent a process. So I have not read any of the other examination reports, but I would bet my eye teeth that we have hundreds, maybe more, examination reports where supervisors threw the same red flags at the banks who were facing the same duration risk. And what those banks did instead is what Silicon Valley Bank should have done from the beginning. They changed it. They responded to their bank supervisors. Bank supervision is not bank enforcement. In order to force banks to do things because of our traditions of the rule of law and due process of law, we follow a legal process that includes courts when we have an enforcement action. And that any bank that does not want to agree to bank supervisory recommendations does not have to until forced to do so through a court of law. But that's not how bank supervision works in the overwhelming majority of instances. The way it works is bank supervisors and bankers themselves collaborate together to identify the pockets of risk mismanagement that arise dynamically in any kind of economic environment. Bank supervisors threw those red flags. We know this to be certain in the instance of Silicon Valley Bank. We can strongly suspect it is certain in hundreds, maybe more, other banks. And the bank supervisors' credit, and to the bank's credits, those that have succeeded, they made those changes. And so I would say bank supervision has been, in this environment, highly effective. But in order to be completely effective in these tumultuous times, it requires bankers to cooperate. And in Silicon Valley Bank's instance, I don't think we had that result. And so with that, I will conclude and turn it over to Rosa.
Thank you very much, Peter, and thank you very much, Nicola, for inviting me to contribute today. It's always a pleasure to work with Peter. He has this view, which is legal cum historian cum economics, which I very much like, a proper interdisciplinary approach. So what were the bank supervisors? And Peter has given us a positive view of the role of bank supervision, which reminded me of something that another mentor for me, Charles Woodhard, used to say, or still says, which is supervision is a thankless task. When you do things well, you seldom get credit. And when you do anything bad, it immediately hits the headlines. I'd like to reflect on 3 points. One is the old and the new. So the old is what Peter was just reminding us, the 3-6-3 rule. And we do need to obviously revamp or remind bankers and their supervisors that we need to mix the old and the new. The old is traditional interest rate risk management. It's at the essence of what the banking business had done over the ages, with the duration of the assets and the liabilities, and then borrow short to lend long. But we need also to consider the new. The new is a stress test. So really, had the supervisors done proper stress tests when it comes to understanding the effects of large interest rate changes? And that's more a question than an answer. And in these new stress tests, we also need to understand what is systemic. I think systemically important has always been systemically important financial institutions. But there is something about systemic importance for the tech sector, which certainly in the case of Silicon Valley Bank was one of the arguments that was put forth for the actions that the authorities took. And also another question I think that rose to mind, not so much by Peter's presentation, by looking at the way that Silicon Valley was offered assistance, is that Silicon Valley Bank evidenced the problems of too small to fail as opposed to big to fail. So how do we limit uninsured depositors from taking losses? So that's my first reflection, which I call the old and the new in risk management. The second point is the point that also Peter mentioned with the intended and unintended effects of monetary policy. Here, the issue is now close to my heart because I'm currently advising the House of Lords Economic Affairs Committee in an inquiry in which they're looking at the operational independence of the Bank of England for the last 25 years and how well has it worked, what are the successes and failures of the bank during this period. And last week, we had Charles Goodhart and Ryan came to give oral evidence. And interestingly, Raghuram and Ryan said that one of the unintended effects of QE was that it had obviously shortened the maturities of the banking system. It not only had fiscal effects, but we had to recognize that the expansion of the central bank balance sheet has also been accompanied by expansion of the commercial bank balance sheet and a shortening of the maturities because of the reserves and because obviously there has been more demand deposits than time deposits. So the kind of interrelation between monetary policy and changes in interest rates and bank management and bank supervision, I think is another lesson. And we have not seen the end. We have seen we are in June, we're not in September. If one goes back to March 2008, and then June 2008 was not particularly relevant. The relevant date became September 2008. So there are things obviously that we do not know because of the confidential information. The third point, and I know that I only have 5 points now for the discussion, goes to the issue of trust and politics. Clearly, not only, and Nicolas told us that the seminar is obviously looking at how effective and ineffective bank supervision has been in the US, but also what are the lessons to take from other historical episodes prior, like the S&L crisis, but also in other jurisdictions. And I think that one of the themes that after the global financial crisis became commonly accepted, certainly in the European Union, but also in a country like Switzerland, is that bank resolution provided a credible system to avoid too big to fail and to avoid reliance on bailouts. And really, what these episodes have shown, not only in the US, but also in Switzerland, is the importance that politics plays still in banking and in bank crisis management. And we need to ask ourselves whether we should rely on ordinary mechanisms or extraordinary legislation. Both the systemic risk exemption in the US and the extraordinary ordinance in Switzerland, suggest questions about credibility. Credibility is very difficult to earn and very easy to destroy. It can be lost overnight. And the package that was put for Silicon Valley Bank, even if it was claimed to be solidarity, it smells like a bailout because the state is the ultimate guarantor, even if it was not legally a bail. And then just on the too big to fails, just to finish the last thing. With the recent banking troubles, again in the US, but also in Switzerland, I will refrain from saying anything about the European Union, at least until we go to the Q&A. Some of the institutions like JP Morgan, HSBC, which acquired Silicon Valley Bank UK, and then UBS have become bigger. And so at some point, we need to consider all antitrust and competition to possibly break up the banks. So the too big to fail, which was a recurrent theme during the global financial crisis and its aftermath, so far the efforts have been in dealing with the TB part of too big to fail, on the TF part of too big to fail, and we need to also tackle the to be part of too big to fail. And I think, I've spent already my 5 minutes, so I will leave you, Nicolas, lead the dialogue for whatever issues or either in the chat room or you want to put to the two of us.
Thank you so much, both of you. That was splendid. Rosa, I have a question of clarification on something you said at the beginning about too small to fail, and I'm not sure I got the point. So can you elaborate on that and explain what you meant by that? You're on mute. Yeah,
I muted myself. That's interesting. By the classification of Silicon Valley Bank as a bank which was not sufficiently systemically relevant meant that there was less intense supervision than it had been systemically relevant. However, the systemic risk exemption was used in order to be able to protect the uninsured depositors. And therefore, the too small to fail is, okay, the bank was not too big to fail, but it was too small in the sense that it was small, but still relevant for not allowing it to fail. So it's kind of playing with the words. So what we were doing is that we were limiting uninsured depositors from taking losses. And the problem I have of that is that by definition, deposit insurance needs to be explicit and limited. If we have a blanket guarantee, then there will be an incentive by bankers and financiers to structure every liability as a legal deposit in order to get coverage. So this idea that we were limiting uninsured depositors from taking losses is something which upon reflection troubles me.
That's very clear. Okay, so I have tons of questions. There are many top-notch experts in the audience. I encourage them to ask questions through the Q&A. We already have a few. But let me start with a comment and a question of my own. The comment, of course, is that I felt completely like the first image of Kermit the Frog depicted in March, going crazy. I'm not sure I would include myself with Peter's comment on the second video of Kermit saying the worst is behind us. I remain very agnostic about that question, and I'm not as willing as Peter to make a forecast about this. But Peter, just to provoke you a little bit, and this is the whole point of this session in a way, because your, I quote you, your assessment that bank supervision has been highly effective is not universally shared. So you said 4 or 5% fail rate, right? You said 190 banks out of 4,000 or something like that. If I want to travel and I see an airline that proposes a 4 or 5% crash rate, I won't view that as very low. So can you give us a sense of what would be a failure in that scale?
Right. That's a good analogy. The uninsured depositors of Silicon Valley Bank did not crash and burn at the failure of its bank. They were made whole, notoriously, in fact. Some of those uninsured depositors, large mature companies that were keeping billions of dollars in a single account, those are practicing extraordinarily poor risk management, and the government made them whole. So I think what we have there is some very intense turbulence, and then the system for ensuring that that no passengers are harmed kicked into place. Now, I tend to view if you are someone who wants to charter a private plane with an inexperienced pilot and go jumping out of planes with parachutes that you haven't really vouched for, Not sure how much we should want that to be the responsibility of all the rest of us to ensure your own safety. There's a risk assumption problem that goes on here. And so with Silicon Valley Bank, the reason why I would say this is not a bank supervisory failure as opposed to a banker failure is we do not live in a world and cannot live in a world where every bank failure is a public policy error. If we live in that world, that means that bank supervisors will take not only the part of the risk management system that is theirs, which is mostly to guide, to observe, and in occasions of a really rather narrow set of factors, enforce. If we make that more of the responsibility of the government, then we have displaced what has been a long and historic and very positive public-private partnership in the US financial system. And many people have made that exact proposal, that the banks are in themselves a kind of franchise or outsourced arrangement of a sovereign power. I just don't think that's historically accurate. I don't think that's descriptively accurate. These are for-profit corporations that venture, that take risks. We want them to do so. We want them to do so because banks that don't take risks will stagnate.
Right.
And where banks stagnate, I think that's a problem. So bank supervisors, blaming them for all of this, I think would be a mistake.
I think we got that point of your argument. There's a question from Jerry Caprio for you, Peter. Can you give us a bit more of the legal framework in the US, and Switzerland may be different, but do the supervisors have to go to court when they issue a cease and desist order? What are the escalation tools? What happened to what is called in the US framework prompt corrective action, mandated early intervention? Because basically the picture that we have is that supervisors of Silicon Valley Bank identified the issues, but didn't really take actions that would make a difference, given that the bank was not cooperative, which is a story you've told us. So how do you answer Jerry's question?
Yeah, it's a pretty highly choreographed set of interactions. Enforcement actions can and usually do arise out of the supervisory process. Sometimes they come as a referral from another agency, like the Department of Justice in a money laundering case or something like that. But they do have a lot of autonomy here. So to answer the question directly, and Rosa, you can correct me if you understand it differently, but I'm nearly certain that the court only comes into place after a cease and desist order is issued. If the bank wants to challenge it, they can do so in courts. But the statute, as written and revised substantially over the years, provides a lot of autonomy for the issuance of those cease and desist orders. Now, the cease and desist orders are they have to be tailored, and they are only specific causes where they can be issued. Things like a certain it can be a personal cease and desist order removing a bank officer or director for certain kinds of activities. A cease and desist order that speaks to a certain monetary penalty, or because there's been an agreement with the bank under certain other kinds of.
But for example, something like completely inadequate risk management, can that generate a cease and desist order?
Yeah, absolutely. There are two ways that it could. The prompt corrective action directives and the safety and soundness orders. Those are both two different species of cease and desist orders. Now, we could see that, and maybe that's a place where we want to say that this has been blamed. But let's think about that for a second. If every risk mismanagement turns into a legal action like this, we have a very different kind of financial system, and that puts bank supervisors on the responsibility to be clairvoyant, essentially. And I think that would be a mistake.
So there have there been cases where banks have has disputed the cease and desist order from their supervisors in court? Can you give us a little bit of a sense of that legal history?
Sure. So coming out of the 1980s, there were a lot of these cease and desist orders that their current statutory architecture arose in 1966. In the 1980s, during the savings and loan crisis, we had a lot of these issued, the most of any time before or since. Many of these were contested in court, usually by individuals rather than the organizations, but some by organizations themselves. But there is a tradition that doesn't exist with the SEC or the EPA, SEC, which regulates capital markets in the United States, the EPA, which provides environmental regulation and enforcement. In those instances, regulated entities sue their regulator all the time. That doesn't happen in banking. And we can speculate about why that is, and I'm happy to do so, but it is a different culture there. So we see a lot less litigation around cease and desist. That would change, I suspect, if cease and desist orders became a primary lever of risk management. I wouldn't favor it. I think that there are better ways to go about things, and I'm not ready to declare supervisory failures in light of 2023, given the climate in which these supervisory actions were taken.
So even Silicon Valley Bank, just to clarify for you, was not a supervisory failure, correct?
I'm not sure that it was. I'm not sure that it wasn't. In that individual instance, I would say that I think supervisors did what they should have done in throwing the red flags. Without the benefit of hindsight, if you had asked me in January of 2023, did supervisors do enough? I think I would have been very angry that the bankers did not do more. And then that leaves a really important set of questions. So there I'm not quite agnostic. I'm willing to say that in the Silicon Valley Bank, especially with Q4 2022, Q1 2023, that maybe that prompter action, better use of some of the other tools might have been better. But that is very different from saying that bank supervision has failed, where we simply don't have that evidence, as Rosa mentioned with we'll call that Goodhart's second law about the profound asymmetry in bank supervision,
right,
where failures are public and their success is all private.
This is great, because these set of questions that you're referring to that come exactly in this assessment, particularly of 22 and maybe early 23, this is exactly what this session is about. So thank you for really zooming in on this. Rosa.
Now, I just want to add, just by the comparative experience, that depositors in the UK branch of BCCI sought damages from the Bank of England for failing in the supervisory duty, and ultimately the Court of Appeals upheld that the Bank of England was clothed by immunity and that therefore there was no breach of supervisory duties. And I think, that in the light of Goodhart's second law, one should approach this field with a few grains of salt, because the very nature of supervision and the very nature of the incentive structure that supervisors have would be lost if we would start to casually allow for supervisory failures to be the cause of claims that can be brought in the course of justice by aggrieved depositors. So in the case of the Bank of England, the case was ultimately dismissed in appeal. And there have been other cases in the EU where also the balance has tilted, instead of liability for supervisors towards immunity for supervisors. I think the balance, unless there is an egregious criminal mistake, the balance is the right balance.
So this is super interesting. The court in the first instance asked the Bank of England to repay depositors of BCCI?
Well, the Court of Appeal by a majority dismissed the appeal, so no way.
Yeah, I'm talking about the first instance.
The first instance brought the issue to the Court of Appeal. So.
Oh, okay. Sorry, I had misunderstood, my bad. There's a question for you, Rosa, from Caleb Nygard, who writes under the name of Barbara Kochwar in the Q&A. So you point, and it's basically about the same issue, because what really I want to dig in today is this issue of discretion and how much supervisors can do beyond just applying the applicable regulations. I think we can all agree that the applicable regulations were not what they should have been. There was too much relaxation in 2018-19. I suspect, even so I haven't checked, that we will all agree about that, but that's not what the session is about. It's really about supervision, which always has a mandate of safety and soundness, always has a mandate of making sure that the bank deserves its charter or license or whatever it is, even going above and beyond the applicable mechanical regulations where you can calculate a ratio or apply a standard stress test assumption or things like that. So Caleb's question is this, Rosa: what about the politics of supervision? What's the optimal level of politics in supervision? And what I mean, the question is about politics, but there is also an associated set of concerns about discretion. So how do you see this kind of, Paul Tucker theme of unaccountable or unelected big power base for supervisors in that case? Should we tie them to the political cycle, as is de facto the fact in the US? Is it important, conversely, that they shouldn't be associated with the political cycle? But then what about accountability? Can you give us a little bit of your thinking about that? Sorry, this was a very long and rambling question from me.
And it is probably difficult to answer it briefly because it touches upon a number of issues. So I think Peter was very right to separate between supervision and enforcement, and we should also separate between supervision and regulation. Regulation has to do with the fact of making rules, and supervision has to do with a complex process, which has to do, on the one hand, on how banks are complying with the rules, the different set of rules, capital, liquidity requirements, but many others that come under the CAMEL acronym, but also it comes under risk monitoring and risk control. And so supervision is a broad process, which in part is dominated by rules, but it also requires the exercise of judgment, the exercise of discretion. And the supervisors, when they exercise their supervisory responsibilities, they have to apply the law, to apply the regulation, but they also have to use their judgment. When I was talking about politics, I was not so much talking about the politics of supervisors, about the politics of how the issues were handled by the authorities. So the involvement at the highest level of the authorities in the US, including President Biden on Sunday, suggests that there was a real concern, a real political issue that in San Francisco, in California, this bank, which was considered to be an icon for the tech sector, was going to be possibly the first, that's perhaps the politicization of the decision, was going to be the first victim of something which could trigger, by contagion, other tech-related financial institutions or institutions which are engaged into lending and taking deposits from business related to the tech sector. So that was the politicization. So still of the crisis management, which led to the invocation of the systemic risk exemption and led effectively to this program that smells like a bailout, even if it was more indicated as solidarity because it's paid on an assessment on the banking system. And then when it comes to, again, Credit Suisse, and that's why I talk about the systemic risk exemption, and then this extraordinary ordinance of the authorities in the case of Switzerland in order to just that. So it was more politicization, not so much of the supervisors, but rather of the decision of keeping these institutions, in this case, selling it to UBS, and in the case of Silicon Valley, claiming the systemic risk exemption, and then eventually also with the subsequent problems, the involvement.
Right.
But then when it comes to accountability, that's a kind of different story. Yeah, if supervisors are independent, like the point that Paul Tucker makes, unelected officials, which is with regard to central bankers, the extent that supervisors are unelected politicians, they need obviously to be accountable. And it's how do you structure accountability ex ante and ex post without holding the supervisors legally liable for failings or alleged failings in supervision, which is a matter of judgment and a matter of discretionary judgment. So a long-winded answer to what is a long-winded question. Thank you.
That's very fair, and many points to follow up on. But one point I want to ask is your point about Silicon Valley, because and I'm leaving Switzerland aside because I prefer to focus this session really on the US experience. But for Silicon Valley banks, there really were these two narratives. There is the one you hinted at, which is this is about Silicon Valley. It's about the ecosystem. It's about the innovation hub. And we cannot afford it to enter a slump that would be caused by the disorderly failure of Silicon Valley Bank. So in a way, not a bailout of Silicon Valley Bank, but a bailout of Silicon Valley. So with a very clear industrial and geographical concentration. And the other narrative is the one that was invoked, systemic risk. So basically a completely different story, which is if we don't do that, we have banks all around the country going into liquidity stress, which is a really different story. Which one was the real story in your view, Rosa? Was it the Silicon Valley story or the nationwide systemic risk? What motivated the decision to invoke the systemic risk exemption?
I was not there when the decision was taken. I think it was probably a combination of the two. I think the two pictures that Peter put at the beginning, there is a lot of bad memories of what happened in 2008, and there is a degree of concern. The thing is that with systemic risk, is a nation systemic risk is very difficult to identify ex ante. It's usually ex post. I mean, who would have told that the crisis of Northern Rock was going to be eventually systemic? So that's one thing. With the tech sector, I can only say the documents I have seen or just some of the pressure emails that were changed, the Twitter stories that, that there was real pressure by some of the entrepreneurs that unless, you save this bank, we're going to see a collapse in the industry. And, contemporaneous with that, San Francisco and the Silicon Valley is obviously going through a bit of a downturn. And so if this could be like, the nail on the coffin. So right. I think it's probably Peter knows better because he's American.
Oh, Peter.
These things. But I think it is probably a combination of the two stories.
What's your take, Peter?
Subject to similar caveats, not only that I wasn't in the room, but that I want to be very mindful of the access to information that the chief decision makers on the government side had that the rest of us did not. I think
still don't.
Yeah, it would be a scandal, an outrageous scandal, if the banking laws and the exceptions within them were used to bail out a sector of our economy, however important. They don't exist for that purpose. That's a fiscal policy determination. It's not a banking policy determination. And of course, the banking system exists to support the real economy, and the collapse of banks that favor and service an important sector of our economy, those are important considerations. But using systemic risk exceptions and declaring unusual exigent circumstances, as was done, in order to support the venture capital community would be a scandal. So I would take that pretty seriously as an accusation. I don't think then it's true for the regulators as they evaluated the evidence, but the noise around these questions as the venture capitalists made these, lobbied in these ways and sought to influence policy decisions to ensure that very wealthy individuals and very wealthy institutions were made whole. I think that creates a background noise that is very difficult to evaluate in real time. My sense is that regulators saw the speed with which Silicon Valley Bank's uninsured depositors withdrew their funds as suggestive of a systemic consequence, where if this bank were be allowed to fail in a disorderly way, or even in an orderly way, that we would see similar consequences for other banks as depositors did not have the time to sort through the sheep of the goats. And First Republic.
So you take their motivation of the decision at face value.
I do. I don't think I share their conclusion. I think what we saw is a very fast disciplining of very few banks. And these are banks that I think we want to be very careful about the idea that we would remove that discipline, the flightiness of uninsured depositors.
Alfredo Danquart is asking, are all depositors de facto insured now in the US?
It's an open question. I don't think so. I think that, Janet Yellen gave testimony the week after these decisions, and she was pilloried for this testimony as she was facing a hostile questioner about that very question. And she was answering and giving an honest and transparent and legally accurate question. Now, the question of whether there's de facto insurance guarantees, I think is an important one. I don't think so.
Am I right? Am I right that after she made that testimony, the markets went down, and she didn't repeat that stance later on. She rather repeated the stance as it had been given by the Fed, that deposits are safe.
Yeah, that's what I would regard as a mealy-mouthed answer that seeks to dodge that very question. The question, and we're having a debate about this, should we have de jure protection for every single deposit? Should deposit insurance affect every single deposit liability for every single chartered bank? And I think that we need to be very careful as we proceed in that view. I think that it is extremely appropriate for uninsured depositors to retain their status as uninsured deposits. And what we've seen in the migration out from the banking sector toward money market funds is not a suggestion that banks are unsafe or unsound. It's that they are not returning market levels of interest where the money market funds would do so, where the holdings of government's own debt would do so. That is a problem for banks, but that suggests that, in fact, we do not have de facto deposit insurance for every bank.
I'm very happy you said what you said about it would have been a scandal if banking law had been used for bailing out a sector or region, because I happen to agree with that. But I want to push you a little bit further on that. I will ask Jessica. I get the feedback that there is a problem with the sound. Jessica, do you hear us well? Sorry for the interruption. Yeah, okay. So apparently that's only among some viewers that there are technical issues, but that's not generalized. Sorry for the technical check. So Peter, just on this, can you go a bit further? I mean, why not? I mean, if Silicon Valley is critical to the US national life, why not use available instruments, even if they happen to be banking law? What is so scandalous about it?
Because it introduces the question of picking winners and losers in the economy. We did this in 2008 and 2009.
Doesn't the Biden administration do that all the time these days? I'm
totally appropriate for the Biden administration to do. And I think that there are other ways that this could have been done. And if it were to be done through the banking laws, I'm not even saying that's illegal. The systemic risk exception has a different provision within it, which is a material adverse economic consequence. So I'm not making the argument that it's illegal to be done. I'm making the argument that it would be a scandal. And if we saw, as we saw in the Obama administration with the bailout of Detroit's Chrysler and General Motors companies, President Obama stood up, said that we are going to use this law, which is the banking law, Troubled Asset Relief Program, and he owned that question. He defended it by saying the constituencies of General Motors and Chrysler are too important to the global economy. We are going to use these, and he became the face of that issue. If President Biden had made the similar determination, I would feel far more comfortable with that. That's appropriate for politicians to do. To have Jay Powell or Michael Barr or even Janet Yellen saying that this is a banking crisis and that we need to reassure the nation's banks and bank customers that our system is safe and sound because of idiosyncratic banking risks. And what we meant to do is a backdoor bailout of one favored slice of the economy. That's the scandal. If that were the determination, and I do not think that it was, if it were, then that is a problem for Joe Biden and an issue for him before the nation to defend a decision like that.
Super interesting. Thank you for that. So time flies and there are many questions that we haven't answered. We're probably not going to be able to answer them all, but let me ask a few of them and ask you to be as succinct as possible. Mark Ginsburg and Z. Pergrossi are asking about the impairment or the loss of value rather of assets with the rates that are rising, and this whole debate about assets that are held to maturity, should they be marked to market in capital calculations. What about that? Is there a case for calculating capital on a mark to market basis in real time? Should that be considered dangerous because it would be too pro-cyclical? How do you think about it? Maybe Rosa first and then Peter.
I think that there is certainly a problem with you asked for a short answer. I think there is a problem with to begin, if we backtrack a little bit, there was a problem that the central banks, generally the central banking community, failed to predict that inflation or the return of inflation was going to be as sticky as it has proven to be. And they call inflation transitory. And therefore, there was not an adequate signaling to the market that actually inflation was going to be far more entrenched and that therefore much higher interest rates were needed. And obviously higher interest rates, have created a problem for the banking system to adjust, but also problems for other sectors in the financial system. And then the arguments that are made on historical cost accounting and market value accounting, I will actually defer to those that have greater accounting knowledge than I have, other than to say that, yes, those are arguments that have been made, as well as differences in treatment when comparing both the US and the EU. I don't know if Peter wants to add something in that regard.
We are currently debating Basel endgame, which is this idea of exactly how we should calibrate questions of capital and liquidity. And I think the distinction between hold to maturity and available for sale securities, including exceptions to their accounting for banks, is one of the hardest questions that we have to confront. The reason it's not easy, Nicolas, you alluded to this a little bit, but it's more complex even than the mark-to-market's pro-cyclicality. It's that banks are not in the business of being evaluated in the same way a money market mutual fund might be, or in the way that a regular corporation might be. We want to assess the value on a mark-to-market basis for these things because their entire purpose is to hold assets that should be made available to sale immediately. Banks are not in that business. They're in the business of maturity transformation, which means that they have that duration risk. They have that asset, that ability to monetize assets of long duration. And if we have risk-taking in this instance, where they were giving just money to the very best of counterparties, I'm not convinced that we should evaluate those on a mark-to-market basis, because that's not the business model. But at the same time, when we fail to do so for the entire asset class, and we say that there are no problems here, uninsured depositors are not going to believe that, nor should they. And so the only thing I'm certain of is that the status quo is not sustainable, that we should make a change there. But I'm not sure exactly what that change should be. It's a hard problem.
That's sobering. Julian, Jürgen Meyer and Jerry Caprio are asking about the stress testing process and the fact that interest rate increases were not really introduced into the stress test scenario. So Jerry has a bit of a facetious question to you, Peter. Wasn't that a supervisory failure? But then the broader question is, why didn't the Fed have any stress testing of interest rates rising? And was it because they were afraid of the contradiction with their monetary policy messages precisely at the time of transitory? How do you think about that, Peter?
I think the stress test issue is a bit of a red herring in this instance, and let me explain why. It's true that stress tests did not model interest rate hikes, in part because we don't see interest rate hikes in a financial cataclysm. We tend to see the opposite, and deflation risk is extremely potent and problematic, and something that banks need to manage against. I'm not saying that stress tests should not in the future manage this kind of issue, but the problem is that these red flags were so basic, these problems so well identified, that no one needed a stress test to know that Silicon Valley Bank had mismanaged its duration risk. We didn't need to know that they had overexposed themselves on both the liability side and the asset side. And the bank supervisors could already see this. If we take stress tests outside of their more formal legalistic context, which is the CCAR and the DFAST, those are the acronyms that apply to the very specific examination procedures, and we think of stress tests instead as a collection of tools to assess prospectively how risk management has been undertaken, then it's simply not accurate to say that stress tests missed this. Basic bank examination caught this problem. The prospective assessment of how Silicon Valley Bank was managing its risk caught this problem. Now, better question then is, why wasn't more done about it? But to say that the Fed screwed up its stress test by not figuring in interest rate risk on the upside, I think misunderstands exactly what the nature of this problem. It's so plain vanilla, so banking 101 that bank supervisors did catch it, but they weren't able to do it.
Still, it does. I mean, accepting that, doesn't it raise a question about the usefulness of stress testing?
No, I don't see why it would. Stress tests are meant to solve a different kind of problem that is harder to do than basic bank examination can accomplish. And those are things like correlated risks. Those are things like counterparty risk. Those are things like dominoes that fall, where you use a very large computer and mathematical model to understand things that are connected in ways that simply looking at a bank balance sheet can't do. Nicolas, this problem was something that any second-year bank examiner could have spotted just by looking at the balance sheet. You did not need a computer model in order to understand the risks that were taken here.
I thought they were learning that in their first year, but I concur. Rosa, a question from Patrick Kennegan, and there's also one for Peter. But for you, do you really think that breaking up the banks would solve any problems? That's Patrick's formulation.
I just think, if we call the problem too big to fail, or too interconnected to fail, or the family of too big to, I think we need to address the issues also of size and the issues of excessive concentration of power in institutions that then implicitly or explicitly expect the government guarantee. That's my concern. So my concern is that if we think that that is a problem, and that was an identifiable problem post-GFC, we need to do something about having even less competition in the banking sector, having even a more oligopolistic system. So, whether that is breaking up the bank, whether that is applying competition, antitrust, I think if we think that too big to fail is a problem, we need to address the issue that is it impossible that this institution will ever fail. The government will always guarantee depositors, and therefore there is every incentive, every model has an incentive to take greater risk. So I think the whole area of competition.
But haven't we seen the opposite, just to be provocative, Rosa? Haven't we seen regional banks take too much risk in the US and then a flight to safety to the big banks? And it was useful to have the big banks, the too big to fail banks,
I don't
take
think
all those deposits, no?
I don't think that's a particularly healthy trend to make the bigger banks ever bigger. So I stand on that I think we need to, in the same way as Peter was now reminding us that it's all balance sheet management, interest rate risk management, and that the stress test has to do with other things, for instance, now in the area also of climate change, including complex calculations. When it comes to competition and antitrust, I think we need to go back to the arguments for competition and antitrust, which is undue concentration of financial resources in a few hands when that leads to government guarantees, explicit or implicit expectation of guarantee from the government in a crisis, and that therefore those institutions can never fail. I think every institution in a market economy should be able to fail, and that incentive.
Peter, Patrick is asking to you, what are the intermediate tools that supervisors can use short of a cease and desist order? So if a bank is like Silicon Valley Bank, not really cooperating with supervisors in the kind of positive dialogue that you have theorized as the basis of supervision with US characteristics, is there any escalation, or is it directly cease and order?
No, there are lots of tools, some of which were used. You escalate red flags into matters requiring attention or matters requiring immediate attention. The supervisors did this. What they could have done that they didn't do, and which I am very willing to identify as a supervisory failure, is the staffing of supervisory discussions goes all the way up to the Fed chair himself in the Fed's instance, or the comptroller of the currency with the OCC or the FDIC chair. What that means is that you'll have an examination team with a lead examiner. A bank like Silicon Valley Bank, which was subject to horizontal review, will include a pretty diverse basis, and that will eventually go up to the division head of supervision regulation at the Fed's board. That person is overseen by the vice chair for supervision, and during the critical period, there was no vice chair for supervision. That was Fed Chair Jay Powell. A phone call from Jay Powell, or from Mary Daly, or from the head of the Sup and Reg division to the CEO to say, we are concerned about these issues, would have a much more immediate effect than the process that we saw. And it's an intermediate step. It's of no legal moment, so to speak, But we have seen, of course, in the conversations around First Republic, we saw a lot of that high level engagement. We should have seen more of that, and that I think is a mistake.
Do we know for a fact that this didn't happen for Silicon Valley Bank in 22?
We don't know this for a fact, but the supervisory report was very thorough and included no such engagement. I'm nearly certain that we did not see anything at that level. But you know, it could be wrong, but I think that would be the place where I'd want to know more.
So many questions, so many threads that are really important. And I think it shows that even so this US banking kerfuffle or episode of March, April has disappeared from the news flow. Well, we don't know whether the worst is behind us, but what we know is that there are many unanswered questions, including the one we were discussing with Rosa at the end on concentration and competitive dynamics. So that will be matters for future sessions of this series. The next session on June 28 will be with Katie Fortune of the Bank of England and Sine Krogstrup of the National Bank of Denmark on central bank digital currencies, because the Bank of England has released a concept paper in February, which is quite advanced as these things go. So we will be one of the many discussions of CBDC, whether they serve a purpose or not. In the meantime, I want to thank again very warmly Rosa Lastra and Peter Conti-Brown for the depth of their analysis today, and thank also the audience for their engagement. Thank you very much to all.